Good morning and welcome to this Wednesday, February 26th edition of Trading Places Live at EarningsBeats.com. I'm Tom Boley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we had a rout on Wall Street on Tuesday, no other way to put it. The Dow Jones down 900 points. Market did try to rally early in the day, but then failed, and we did see it was a little different day than we saw the previous day. Both Dow days were down. I guess we were down a little over 1,000 points on Monday and down close to 900 yesterday. But the way we got there was completely different. So let's go ahead and take a look at some of these numbers. That really doesn't even do it justice here. The Dow Jones showing that red filled candle on Monday. We really didn't go down much from the open. And I'll show you what I mean. We'll come back to this chart in just a second. Let me show you. If I go to the diamond, which is the ETF that tracks the Dow, you see how that candle, that filled candle, is much smaller? Take you back again to the industrial. See how the industrials looks like there's a lot more selling after the open? The reason for that is a lot of the Dow components don't open right at 9:30. Sometimes they're delayed about 10, 15, 20 seconds. So at the very opening bell, some of the Dow components are treated as though they haven't moved, that they're unchanged. And so that's why on the Dow, when you get these big gap downs or big gap ups, the candle on the INDU or the dollar INDU versus the diamond is different because the diamond's taking account into where all of the Dow components are opening. So just one little thing to keep in mind when you're looking at the charts, especially if you use candlesticks, that the diamonds are more appropriate looking at candlesticks, especially when there's been a big gap, rather than looking at the index. Same goes for the S&P 500 versus the SPY. The NASDAQ 100 and the QQQ are about the same. So when you looking at the candles, there's generally not as big of a difference there. Anyhow, when you look at the two candles from the last 2 days, here was a 1,000 point drop on the Dow, and here was a 900, almost a 900 point drop if we look at it on a Dow perspective. So let's go back and look at this again. So here you can see the two movements, but the actual action during the day was completely different. The volume was a lot heavier yesterday, and when we look at an intraday chart, you will see that here we gap down. Remember on the diamond, the DIA, we were probably down around here on the open, around 28.2. So we really just went sideways all day. A lot of panic, a lot of selling, but the shares were being accumulated. Yesterday, we gapped up, and then we sold off all day. So this is much more indicative of distribution to me. That doesn't change my overall view, not at this point of the market. I still believe we're in a secular bull market. I think we're going to go higher. I've said many times along the way, I mean, I can't predict when we're going to have these panics in the market. We saw one in 2018. We'll talk about that in a little bit when I go over the VIX and what a higher VIX can mean. But we're going to have corrections. We're going to even have cyclical bear markets within secular bull markets. So, this type of thing, the coronavirus, very difficult to predict. I do think that there's way too much media coverage of it. I think that is adding to the fear more than it needs to be. But I'm certainly not a health official. I can't tell you, what impact the coronavirus is going to have. I just know that it does add, the media is adding to the fear level. I did see this morning President Trump's announced that at 6 o'clock today, he's going to have a press conference in the White House with CDC officials to talk about the coronavirus. I don't know exactly everything that's going to be discussed, but I know that, obviously President Trump watches the markets very closely and doesn't want anything to take the markets down. I don't want to get into any kind of political discussion, but I'm sure that has a lot to do with the press conference that's going to be held later today. All right, going back to that chart that we started with, just wanted to quickly just go through the Dow down, again, 900 points. The S&P 500 down 98 points yesterday. The NASDAQ was down 256 points. I literally 3 days ago was talking about the NASDAQ getting close to 10,000. Now here we are 10% away from that, even more than 10%, down at 89.65. Mid cap stocks. I mean, you know, when you look at the mid cap and the small cap, yes, the major indices are giving back a lot of gains going back a couple of months. The mid caps now are almost back to where they were back at the end of November, or excuse me, end of October. And that was 3 days removed from setting a new high. That's been a huge drop on the mid caps. Over 2,100 down to 1950. So that's 250. I mean, I don't know, what is that, 13%, 12, 13%? Small caps, not any better. Big drop, and actually maybe even worse because we are below the levels that we saw at the end of October. So small caps quickly giving up even more than the other indices. You would think that these groups, because they were already hit or they didn't go up as much, they wouldn't get hit as much on the selling, but they're actually getting hit harder. Down here at the bottom, I've got the 5 sectors that performed the worst yesterday. All 11 sectors were down, so it was widespread selling. Even the defensive groups sold off. They did better on a relative basis, but they did sell off. Energy, after that quick little bounce, testing the 20-day moving average, has really fallen apart here. Same with materials. Materials did climb back up above the 20-day, but just this week, you can see the huge deterioration. Big breakdowns below these prior lows. Industrials getting hit hard. Financials hard, getting hit hard. And even technology, which has clearly been the best group throughout most of this bull market run. Technology got hit very hard yesterday. Actually, you can see the hollow candle. So a lot of buyers when we had the big drop yesterday, but that day before yesterday. But yesterday, that was not the case. We actually moved higher on the open and then sold off all day, and you can see that volume coming in. The 10-year Treasury yield, I can tell you, first of all, that we only have one economic report of any substance today. That'll be the January new home sales coming out at 10 a.m. The estimate is for 710,000. 10-year Treasury yield, I just want to remind everyone, especially if you don't have a long-term history of the market, 10-year Treasury yield has been in decline for 40 years, 1981 to 2020, 39 years. We have put in these lows down around 1.34, 1.35, maybe a little bit higher back in 2012, might have been right around that 2.38, 2.4 level. But we are right on the cusp. And in fact, yesterday we did close below a very key level. So here is the 10-year daily chart just showing closes. And you can see yesterday's close, which was at 1.33, 1.33%, took out the lowest close that we had previously seen. So yesterday was the lowest close on the 10-year Treasury yield in history. Now, I know that's definitely sparking some fear as well. I don't look at that nearly as negatively just because we've been coming down a lot with the yield. I don't think it's about, at least up until the coronavirus, it has not been about slowing economic growth, that the Treasury market was fearful of that. In my opinion, it was all about the lower inflation readings that we've seen, inflation readings that are much below the Fed's target levels. So it's given them the ammunition to lower rates. The bond market's been calling for it. And now I think the coronavirus is adding to it. And there is an element now, I believe, of the market anticipating that we might have, even if it's just temporary, we might have a little bit of a slowdown. There's no doubt that there's been an impact. I mean, we know companies, especially companies like cruise lines, airlines, you know, those companies have been directly impacted by the coronavirus and the fears around it. So there's definitely going to be an impact. The question is how much of an impact and how long is it going to last? And I will say that the stock market has a history of overshooting in both directions, but especially when the market's fearful. So I know it's hard, you know, watching investments go down. And in my daily market report that I sent out to members yesterday, I took a much more cautious stance just because of the fear level. I know what happens to the stock market when it gets fearful. It doesn't matter if it's rational. Usually it's not rational. But when the market's fearful and you're a short-term trader and capital is king, and you know that the volatility is picking up, I've said so many times, I do not like to trade a market with a high VIX. And when I say high VIX, I'm talking about anything over the mid-teens, but especially when you get into the high teens and into the 20s. It's just that the market is so volatile. It's like flipping a coin. Are we going to be up today 500 on the Dow? Are we going to be down 800? You know, can we trust this open? Right now, I think last time I looked, the futures were pointing to and I'll give you those numbers here. Futures were pointing to the Dow being up 100. Now I see the Dow's only up 37 in pre-market. I saw it went red a little while ago. This is just on a small scale what we could see during the day today. And so I just don't like to trade in a market that is just irrational. The behavior in the market is completely irrational. Now, what I thought I would do, here's the VIX, and this is a messy chart. I'm going to help clean this up in a little bit. But what I wanted to do is just over the last 10 years, just show you where we are on the VIX right now. We closed yesterday at 2785. And when you go back and you look, we don't have a whole lot of history in the last 10 years, especially the last 8 years, with the VIX moving into the 30s. Yesterday, we hit 30.25. So I thought what I would do is break down some of these periods, 2019, 2018, well, actually the end of 2018, the beginning of 2018, and then going back into 2015, early 2016, and maybe one trip back here in 2014, just to take a look to show you what happens when the VIX gets to these levels, when we get this kind of fear that starts permeating the market. First one I want to do, this is the fourth quarter of 2018. So I've broken it down. So you're only seeing a chart from July of 2018 to March of 2019. So that's what this chart is spanning. The top is the S&P 500. The bottom is the VIX. Now you can see they're almost mirror image charts. As volatility starts picking up, fear starts picking up, the S&P 500 starts dropping. And when fear starts getting out of hand, look how fast the market drops. I mean, when we get up here, we break to 25, 26, 27, 28. We're talking about 3 days, the market dropping from almost 2,600 to 2,350. And that's kind of what we're going through right now. Just a quick, 8, 9, 10% haircut, more than that in some areas of the market. You take 6 months or 4 months to go up 10%, it takes 3 days to go down. And that's the scary part when the volatility starts to rise. Now, as you look at this, when we got up to about 27, 28, we closed at 27 and change yesterday. That's about where we were here in December of 2018. And, history isn't going to perfectly repeat itself. But the point I'm making is that when the VIX gets up to this level, we can see a very, very sharp sell-off. And we have been seeing a very sharp sell-off. So the fact that we've been down 2 days, maybe this is it. We don't know. But the risk is still great to the downside in the very near term until we bottom on this VIX. Whether it's today, maybe it was yesterday. That would be kind of weird, rare for it to finish the way it did yesterday. Normally you have one more push. Maybe prices go lower, but the VIX starts coming down. That would be a pretty good sign, telling us that the fear is beginning to abate a little bit. But once you see that VIX start to come down, that's pretty much the signal that, hey, it's time to at least begin thinking about getting in. Now, one strategy I use sometimes too when I'm thinking about getting back in is I tend to avoid individual stocks. When I look to get back into the market, a lot of times I'll just look at the spider. Because if the market rallies and it rallies 5%, spider is going to be, I'm going to make good money on that rally. But if it keeps going down, if I'm wrong, I'd rather be in the index than individual stocks. Some individual stocks can really get hit hard, much harder than the overall index. So that's just one thing I do when I'm trying to maybe put my toes back in the water is I'll look to maybe those ETFs. So this was fourth quarter 2018. Here's the first quarter of 2018. So here was the situation where we went down and we never put in another lower low. We just went straight down. Market was very bullish. We went straight down. My gut is maybe we could do something like this, especially if we have another 1 or 2 days of selling, that off of a secular bull market advance, the first push to the downside is likely to be the worst. That held, as you can see, back in 2018. That low with the VIX moving up into the 40s, which was crazy. That was the low that ended up holding. We never went back below that level. So I think that's possible. But again, you know, when you start to see these kinds of candles, this is what I'd be looking for. Now, it didn't mark the exact bottom, but it was pretty darn close. When you get fear level that's just off the chart, seems off the chart, and then it reverses, has a big reversal, that usually means you've kind of capitulated. And I know, you know, you look 2 or 3 days later, that would have been very scary holding, you know, onto this breakdown with the VIX, you know, turning back way up near 40. But as it turned out, that reversed as well. And we did see a major bottom in the stock market. The lesson to be learned more than anything else is that I believe a major bottom is being formed with this VIX reading up where it is right now. I don't know where that bottom is just yet. I don't know if it's going to be where we are now, 5% below where we are now, 10% below where we are now, because again, the market can move very quickly in just a couple of days. If you time the bottom wrong by a day or two, it can be expensive. And really, to be honest, trying to time this bottom is very, very tough. It's probably a lot less chance than flipping a coin. Flipping a coin at least gives you 50% chance. So I would be a little careful for sure here over the next couple of days. One piece of good news is we have gotten through the 19th to the 25th. So if some of this was related to all the option activity that we had last week, you know, a lot of times the market moves down with options expiring, and then the week after options expiring can be difficult. That's why historically, in my opinion, the 19th to the 25th has been such a bad period. Well, yesterday was the 25th, so we've moved out of that period. So that's at least one positive in terms of seasonality. Now, I don't buy stocks just because of seasonality. I use that as kind of an indicator, kind of like RSI or PPO. I'm still looking at price action. I'm looking for reversals. I'm looking for things that would help mark a bottom. I'm not looking at things saying, oh, it's 26, I'm going to buy. I think that would be a mistake. All right, one other period I just wanted to show you, and this was back in 2015, 2016. And you can see here, big drop in August of 2015, the huge spike in the VIX up to 50 in that case. Quickly right back down again, but it got up to 50. That low, we went back down and tested it, didn't break it. And I remember this period back in January, February 2016, because I remember the XLY, XLP ratio was starting to break down. We were taking out these prior lows. The VIX had, for the most part, we did come back down here and get down to around 15, but we were moving back up above a key level around 17. Price action was breaking down. I was really, for a brief, I'm going to say 3-4 week period, I had turned somewhat bearish back in 2016. And then when we came right back up and the VIX dropped below 15, that pretty much put that to bed because normally you don't see the VIX drop like that in a bear market. But here, I mean, you can see how much further you go when you get this. In this case, we got to 27.5, and we were probably at about 2,025 on the S&P. We dropped another 150 points, 7% in about 2 days. It was panic. It's not rational. And that's why we can't, it's hard to quantify what's going to happen today or tomorrow because you don't really know what's going to happen in a panic market. Here you get up to 27, 28. We had one more day and a big reversal. I mean, this is one thing I would be looking for. Let's say today we start off okay, and then we start to see that selling really kick in again. And then in the afternoon, you see a lot of buying and you come back in well off the lows. That's probably a good sign in the very near term, at least for a short-term bounce, especially with the VIX likely up into the 30s. I mean, if we have another down day intraday, I would expect we're going to see the VIX moving well into the 30s. We get a big reversal on the market and a big reversal on the VIX, that is likely to print a significant bottom. So these are just some of the things I would be looking for. Spent a lot of time on this, but I do think that this is the most important part of the market right now. Throw out, you know, strong earnings, throw out the Fed, throw out this, throw out that. It's really all about the fear. And until we capitulate, until that fear, until we can see that that fear is starting to dissipate a little bit, then it's going to be hard to mark a bottom. Oh, I did have one other one. So this is the fourth quarter of 2014, and you can see in October where the S&P 500, we get up to 27 and change or whatever. See this long tail? We actually went up to 31, but you see the hammer on the market and that long tail to the top, that marked the bottom. That was it. So bad news is we're in a very, very panicked market. The good news is high panic marks bottoms. So it's just a question of how many more days of this do we have? Is the 30 level enough on the VIX, or do we hit 40? Do we hit 50? If we do, it's probably going to happen very soon, and it's going to coincide with a lot more selling. So today's going to be a big day for the market. I don't want it just to go up 100 points at the open and then drift sideways. I would rather that it either capitulate to the downside or take back off to the upside, one or the other. I think the sideways action is going to make it actually even more difficult. All right, let's talk a little bit about earnings. We did have a number of earnings reports come out last night and this morning. And Salesforce.com reported they did beat on their bottom line, 66 cents versus 55 cents. Stock down 1.5% in pre-market, though. I'm not going to annotate, but you can see pretty clearly price support around 178, 50-day moving average sitting at 178.11. Looks like we'll probably open around that level, and we'll have to see where we go. If we do break down below that level around 178, then I think probably somewhere down around 168 comes into play on Salesforce.com. Insulet, PODD, P-O-D-D. This company has been one of the leaders, and you can see on a relative basis, it's been one of the strongest stocks in medical equipment. I'm kind of surprised, but this was not a good report. They actually missed on their earnings. 8 cents versus 9 cents. Stock's down 7.5% pre-market. That came after a 5% drop yesterday. We're going to probably be down unless we get some kind of recovery. We're going to gap down below that 50-day moving average. It's been a great company, but these companies are priced for strong growth. You don't want a company like this missing earnings expectations. So I have a feeling this breakdown below the 50-day is probably going to be a big negative for this company. Planet Fitness, another company that's been on fire. I expected good numbers. They beat 44 cents versus 41. Stock's down 5% in pre-market, though. I did make the comment yesterday. I mean, if coronavirus fears were to pick up here in the U.S. and we started seeing more cases, this is the type of company I'd be real careful about, because it's a company that benefits from basically mass gatherings of people. And I'm not saying that the company or that the virus is going to take hold in the U.S. It's going to be any kind of a mass pandemic here, around the globe. But all it takes is fear and the thought that it could be bad that will drive a lot of folks out of a stock. So this is the type of stock that we might want to keep a really close eye on, and probably one that I would not be overly excited to be holding given the fears that are out there right now. Toll Brothers, TOL. Stock missed. This one was surprising too, because home builders have been pretty good. Now, Toll Brothers has not been one of the best home builders, but home construction's been strong. Interest rates continuing to drop, but they dropped. I mean, they dropped a bomb. 41 cents versus 45 cents. They came up 10% short on their earnings. Stock was down yesterday, 5.73. That actually looks good compared to what we're seeing this morning. Stock's down 11.27% this morning. So we are likely to come all the way back down here. Now, many times when you get these stocks with big drops, and I'll be showing you a little bit of this in the 3 you must see in just a bit, but when you get these big drops at the open, market makers are on the other side of the trade. So sometimes you'll get a bounce initially. So I would maybe look for big gap down, followed by some intraday buying, maybe even a lot of intraday buying. But if we can't get back through that 50-day moving average, I think I'd be careful, especially with this one not even being one of the best stocks within the home construction space. Let's see what else we've got here. All right, I'm just delivering all kinds of bad news. Let's see if we can find some good news on here. TJX. Here's a company that actually had been looking very good relative to its peers. Apparel retailers been doing okay, but we set highs back over the summer and into the fall. But really, we're just kind of going along for the ride, and the ride hasn't been that bad in apparel retailers. So this wasn't a bad-looking chart. They did come out. They beat 81 cents versus 77 cents, and they are up 6.5% in pre-market. So it looks like they're going to be well back up here, maybe into this gap resistance zone, maybe closer to 63. We'll see. But this is a company that You know, if it doesn't gap up above these prior high candle bodies, I'd be careful. That could lead to more selling after the open. How about MIDD? Another good one here. This is Middleby Corp. They beat on their bottom line pretty easily, $2 versus $1.72. This is in the non-durable household. No, it's not. What is that? HD. HD. Oh, durable. It is durable household products. Okay, so in that durable household products group, which had been really strong until mid-January, you can see it's fallen off, and the relative strength of the group versus the S&P 500's fallen off. Versus the group, though, we were starting to see strength after a long trek downwards. This won't hurt. I mean, obviously, we're getting a pretty nice report. Easy beat on the bottom line. Stock's up 8.6% pre-market, and it was down at support. Now, 8%, that doesn't rectify all the wrongs on this chart, but it'll help. You know, it's probably going to move the stock up right around 114. In my opinion, needs to probably clear 117.5 on a close before I would start to even consider the stock because of its history of relative weakness down here. Let's see. I'll give you one more. How about Office Depot? Small company. I had liked this one for a while, and it kind of fell apart, or at least pulled back. I wouldn't say completely fell apart, but it made a big run. And here, yeah, this is a level I'd be watching down here around 215. But it's been going sideways. The stock actually came out, beat estimates, 12 cents versus 9 cents. And the stock is up 8% pre-market. So that would put it up into the 250s. Still not good enough to get a breakout. We need to see this close up here above 280. But this is a stock that is in an uptrend and is sideways consolidating. On a relative basis, it started to show strength. It's kind of been, you know, going along for the ride here really throughout 2020 so far. This will help. We'll get a nice pop for sure. On a relative basis, we'll see whether we can hold it, and even better, whether we can build upon it. I'd like to see this relative breakout versus specialty retailers. Take out this level, take out 280, and then I think Office Depot has a chance to run again. One other stock, and this was a stock that was upgraded yesterday. I mentioned it on my Trading Places live show over at Stock Charts TV. Didn't understand the upgrade. When you look at this chart, I mean, look at AMC Networks downtrending. Broadcasting and entertainment has not been a great group, but it has been moving higher. But here's a component stock not moving higher. And you can see the relative weakness, which is horrible. So the stock gets an upgrade. And I said there's no way I would ever consider an upgrade here. The stock opened up 36.5 yesterday, 36.30. Finished at $33. Big reversal. Today it's down another 1% on earnings. They missed earnings. Not a big shocker when you look at what's going on. Look at all the volume on the downside. I mean, this is just reeking of distribution. I don't know how anyone could come out and upgrade a stock looking like that. All right, let's move on. We do have just a couple of upgrades. I'm going to go through these very quickly because we're running out of time. CME is being upgraded on a relative basis. I think the stock looks okay. Selling has been heavier of late. I'd be real careful if the stock were to lose about the 190, 195 level. So it gives you maybe 5-6% to the downside. I'm just okay with this upgrade. Another upgrade, I do not understand this one. Kratos, KTOS in the defense group. Maybe it's a valuation upgrade and you might see a little bit of a pop. But, I mean, look at the relative weakness. It's one of the worst stocks in the defense group right now. No, thank you. One downgrade, we did get a downgrade on DHI, which is a home builder. Now, unlike Toll, this one's a little bit better. So this move to the downside, I actually think when the dust settles here, I think we could get a pop on some of these home construction. They're getting benefit of some really low interest rates right now. So I think this could be a buyable situation, especially if you get down to around 56. The market reverses. I wouldn't be surprised to see DR Horton have a pretty nice recovery. All right, let's move on to the three you must see. And these are all based on companies and how they reported yesterday with earnings. So PANW, Palo Alto Networks. Talked about this one yesterday, about the key closing support down here around 195. We went below it intraday, came back up above it by the close. This is not a good looking chart, so don't misinterpret anything here. but it did reverse where it needed to at price support. So this is one I think in the short term might have a chance for a little rally here. And by the way, close below 195, all bets are off. Keys, another company reporting earnings yesterday, gapped up. Look at where we broke down from 100. We gapped up. We opened at 99.79, right under the 50-day moving average, and we sold off all day long. So company, gapped up into the middle of a range. This was not a gap up in a breakout. So a lot of times you get a gap up, everybody's wanting to get in, chasing that rally, and of course market makers are shorting on the other side, and we see a big sell-off. The final one I wanted to mention was HD because I specifically talked about this one. They were looking to open up around that 246 area yesterday, or yeah, actually we just opened today. So this would have been yesterday's candle. Let me show you where the open was. So the open yesterday was 246.10. The prior candle body resistance was 247.02. So I said if the stock opens above 247.02, it's likely to go higher. Below 247.02, you want to be careful. It opened at 246.10, got as high as 246.97, almost a resistance, and then the big selling kicked in. Stock was down about, I don't know, $7, $8 from that open into the close. Home Depot, any other stock. I mean, it's really, when you're holding a stock into earnings, I like to see that breakout on the open. If I'm almost there and not quite, that to me, normally I'll just take the money and run, not take a chance. If it breaks out, great. I can always get in later if I want to, but I protect those profits when I see that because you can see how quickly market makers just took it right out from under everybody. All right, quick update on the market now that we are open. Let me give you, we got the Dow up 143, S&P 19, NASDAQ 65. So we're getting a little bit of a bounce here in the near term. I would be careful. I'm going to throw one more thing out there for you to watch. Normally when you're down like this, and we got a long way to go to hit the 20-hour EMA, that would be all the way up at 3220. That would be about 70 or 80 points. But if we were to climb up into that area, that to me would be a little bit of a short-term warning sign because a lot of times when you're in this short-term downtrend, you hit that and you fail and you begin to falter again. So I would be watching that on any kind of a rally, but watch the VIX today. That's going to be really important, especially if we break to new lows. All right, that's it. Ran a little bit over. Sorry about that. Everybody have a great day. Happy trading, and see you tomorrow over at Stock Charts TV. Take care.